Welcome to Iron Financial. This is the show where we help you forge a stronger portfolio, and we do it by putting companies through a real stress test. We cut through the market noise, we ignore the hype, and we focus on what really matters, the fundamentals. Today, we're digging into Builders FirstSource, ticker BLDR. They just dropped an earnings report that frankly was a bombshell. The market reacted, and it reacted badly. And we're here to sift through the rubble and answer one critical question. Is this stock's drop a foundational buying opportunity, or is it a sinkhole just waiting to swallow up your capital? Let's get to work. And rubble is absolutely the right word. I mean, look at this. A 4.6% drop in one day, that's not a small move. That's a serious jolt that has investors who thought they were on solid ground suddenly questioning everything. You can almost feel the anxiety in the market. Everyone is looking at this fallout, and they're all asking the same thing. Is the party over for this stock? Exactly. And that is the central question we're here to answer today. When a giant in its industry, like Builders FirstSource, takes a hit like this, you have two possible outcomes. Is this just a superficial crack in the facade? A chance for savvy investors to get in at a better price? Or are we seeing the first signs of a much deeper, structural failure, a house of cards that's about to come tumbling down? One path could lead to incredible value. The other leads to a total portfolio demolition. Our job is to figure out which path this is. And we don't guess. We run the numbers. We're putting BLDR through our full 5-part financial stress test. First, we'll look at the headline hit. That's the surface-level damage that caused the panic. Then we'll dig deeper for the cracks in the foundation, looking for the real reasons behind the weak numbers. After that, it's time for the heavy lifting, the balance sheet stress test, to see if this company can truly handle the pressure. Then we'll take the market's temperature, gauging market sentiment. And finally, we'll put it all together and deliver the Iron Financial verdict. Let's dive in. Okay, first things first, the headline hit. This is what everyone saw on earnings day. These are the raw numbers, the initial shockwave that sent traders scrambling. You can think of this as the first few body blows that really tested the company's armor and sent a clear signal that something was wrong. Let's break down exactly what the market saw. First up, the big one, earnings per share. Wall Street had a consensus number they were looking for, right around $1.31, while BLDR came in at just $1.12. That's a 19-cent miss. Let me be clear. In a market this sensitive, you don't miss earnings. And you certainly don't miss them by this wide of a margin without paying the price. This was the first giant red flag that immediately screamed that the company's profit engine was stalling out. Next, we look at the top line, revenue. It clocked in at $3.4 billion. Now, that sounds like a lot, but it was a shocking 12.1% lower than the same quarter just 1 year ago. It also missed what analysts were forecasting by about $60 million. A double-digit drop in revenue isn't just a slow quarter. It's a huge signal that demand is drying up. Management can spin it however they want, but a 12% drop, that's a number that speaks for itself. It tells you the entire business is facing serious headwinds. But honestly, this is the number that really caused the panic. Adjusted EBITDA. It's a key measure of a company's core operational profitability, and it absolutely cratered. It fell by 44.3% compared to last year, down to just under $275 million. The company said this was mostly driven by lower gross profit. Think about that. In just 1 year, their core earning power was cut almost in half. This is where you go from having a revenue problem to having a full-blown profitability crisis. Whoa, okay, let's just pause on this slide for a second. I mean, look at these numbers. They are just brutal. Net income down over 83%. 83? That's not a decline, that's a complete collapse. The profit just evaporated. So I have to ask the question on every investor's mind right now. Is this just a bad quarter? Is management going to blame the housing market and say this is just a cyclical storm that'll blow over? Or are we looking at something much deeper? Is this evidence of some kind of structural rot in the business itself? Because from where I'm sitting, this looks less like storm damage and more like a planned demolition. And that is exactly the right question to be asking. It leads us perfectly into our second section here. We have to get past the what and start drilling down into the why. We're going looking for those cracks in the foundation. What are the real underlying causes that led to the financial mess you just saw on that last slide? This is where we separate the company's story from the cold, hard data. So here's the story management is telling. They're pointing the finger directly at the housing market. Their official reason for the weakness was, and this is a direct quote, a below normal starts environment. They're talking about housing affordability challenges, shaky consumer confidence. Basically, they're saying, hey, it's not us, it's the market. The narrative they want you to believe is that they're a great company that's just navigating a really tough storm. So, okay, let's put that story to the test. And this chart really tells the tale. This shows their core organic sales. That's the really important metric that strips out any sales they got from buying other companies. Overall, it was down 14%. But look at the breakdown. The weakness was everywhere. The repair and remodel business, which is usually pretty resilient, was down 6.5%. Single-family homes, which is their absolute bread and butter, down a painful 15.4%. And then look at multifamily. It just fell off a cliff, down over 20%. This wasn't one part of the business having a bad quarter. This was a broad, deep slump hitting every single segment they operate in. Right, so it's clear demand is falling across the board. But this slide right here, this tells me there's a much bigger issue than just lower sales. Look at these margins. Gross margin, down 250 basis points. And that adjusted EBIT margin, it got absolutely hammered, down 470 basis points, all the way to just 8.2%. So this is where that whole "it's just the market" story really starts to fall apart for me. The question is every company in this business getting squeezed this hard? Or is Builders FirstSource just failing to control its costs and maintain its pricing power? This kind of margin compression tells me they're getting hit on both volume and price, and that is a very dangerous combination. That's an excellent point, and it's the perfect lead-in to what I consider the most important part of this entire analysis, the balance sheet stress test. Look, a good company can survive a bad quarter or even a bad year if its financial house is in order. But if the balance sheet is weak, that's when a small problem can turn into an existential crisis. So now we ask the big question, can this company's financial structure actually withstand the pressure of falling sales and shrinking margins? This is where we do the heavy lifting. And what we find is a real tug-of-war on their balance sheet. On the one hand, you have some good things, the framework. They have $1.7 billion in total liquidity, which is a pretty solid cash cushion. And even with all the problems, they still managed to generate $874 million in free cash flow for the full year. That's their strength. But then you look at the other side, the load. Their net debt is a hefty $4.3 billion. And check out this leverage ratio. Their net debt to adjusted EBITDA has shot up from a pretty healthy 1.5x last year to a much more worrying 2.7x today. They are taking on more debt at the exact same time their earnings are shrinking. That is the classic recipe for financial stress. Okay, so you're talking about financial stress. The source material brings up a pretty specific tool for this, the Altman Z-score. Now, that's a term that probably sounds a little intimidating to a lot of our listeners. It sounds like something you'd see in a science lab. So break it down for us. What exactly is this score, and why should an investor care about it? You got it. The Altman Z-score is basically a financial physical. It's a time-tested formula that takes 5 key financial ratios, things that look at profitability, leverage, liquidity, all the important stuff, and boils them down into a single score that predicts a company's probability of going bankrupt. As the slide says, a score over 3.0, you're considered safe. Below 1.8, you're in the distress zone. BLDR score? 2.9. That number puts them squarely in what's called the gray area. It means they aren't on the brink of disaster today, but they are getting uncomfortably close. It is a major caution flag that tells us that while the company isn't failing right now, the financial stress is building up to a level that proven models are starting to see as dangerous. So we've stress-tested the company's internal health, we've seen the cracks in their operations, and the growing pressure on the balance sheet. Now let's switch gears and look at the external view. How is Wall Street, the so-called smart money, making sense of all these conflicting signals? Are they seeing this as a buying opportunity? Are they holding back? Or are they selling? This gives us a really good idea of how the pros are viewing this company's risk profile. And what we see is, well, a complete mess. There is zero consensus here. You've got 9 analysts saying buy, 11 saying hold, and another 3 yelling sell. This is basically the definition of a divided street. And what that tells me is that the experts are just as confused as anyone else. The bulls, they're probably looking past this bad quarter and focusing on the company's long-term leadership position. But the bears, they can't look away from that 2.7x leverage and the collapsing margins. Why such a huge disagreement? What is each side seeing that the other isn't? Well, let's give a voice to that skepticism. This quote from Wells Fargo says it all. Even when some analysts were raising their price targets after the earnings report, which they often do just to keep up with where the stock has been, the language they used was incredibly careful. Wells Fargo kept a cautious rating. In Wall Street speak, that's code for, yeah, we see the potential down the road, but the risks right now are just too high for us to recommend it. It perfectly captures the uncertainty surrounding this stock. Even the bulls are nervous.
And a big reason for that caution comes down to this, the valuation. After the stock's big run before this earnings report, it is just not a bargain. The price to earnings ratio is almost 22. Price to sales is at 0.83. Now, as the table shows, these numbers are within their historical ranges, but they're nowhere near the low end. You're not getting a deep discount here to compensate you for taking on all the risks we've just talked about. For a cyclical company with rising debt and falling profits, you want a margin of safety. Looking at these numbers, that margin of safety just isn't there. The stock isn't cheap enough to be compelling.
Okay, that brings us to the final section. We've looked at the headline damage, we've identified the cracks in the foundation, we've put the balance sheet through a stress test, and we've seen that Wall Street is completely divided. Now it's trying to put it all together, weigh all the evidence, and deliver the iron financial verdict. Is this an opportunity or is it a trap? First, let's be fair and lay out the bull case, because there definitely is one. You can't argue with the fact that Builders FirstSource is the market leader. Their size and scale give them a huge advantage. And even with all the problems, this business is still a cash-generating machine. $874 million in free cash flow last year. They're using that cash to buy back their own stock, $400 million worth, which helps support the price. And look at the institutional ownership, over 95%. The so-called smart money has a massive stake here. Finally, their guidance for next year is projecting stability, not another collapse. These are the strong, load-bearing walls of the bull argument. But you can have the strongest walls in the world, and it doesn't matter if the foundation is flawed. And the bear case is all about those flaws. Profitability isn't just declining, it's in a free fall. Margins are getting crushed. That rising leverage, that 2.7x number, that is the single biggest red flag for me. In a cyclical industry facing headwinds, that's just playing with fire. Then you have the Altman Z-score of 2.9, which is a quantitative model scrimming, warning, this is a tough business in a tough market. The momentum is negative, and the experts are all arguing. These aren't just little problems, these are deep, foundational cracks. So it's time. Here is the final verdict from Iron Financial. Builders FirstSource is not a house of cards that's about to fall over tomorrow. This strong cash flow and their market-leading position provide a solid enough frame to prevent a total collapse. However, it is, without a doubt, a structure under a tremendous amount of stress. The combination of rapidly increasing debt and sharply falling profitability is a toxic cocktail for any company, but it's especially dangerous for one in a cyclical industry like housing. Yeah, that's the bottom line. The risks here just seem way too high for the potential reward, especially at this valuation. The red flags are everywhere. The Z-score is in the gray area, the margins are getting squeezed, the debt is piling up. It all points to a high-risk situation where the downside just feels a lot more real than the upside right now. So for our listeners, our verdict is clear. This is a structure under stress. Don't be the hero who rushes into a shaky building. Let the inspectors do their work. For us, that means waiting for proof that repairs have been made. Specifically, we would need to see that leverage ratio get back below 2.0x, and we'd want to see at least 2 straight quarters of stable or improving margins. Until then, we wouldn't consider laying a single dollar on this foundation.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.